Welcome back to the Global Ledger. I'm Justin. In the last few episodes, we've built a clear view of the institutions that make modern markets work. Dealers, money market funds, and the architecture that holds the system together. Today, we're going to shift our attention to some of the largest but least talked about players in global finance. It's pension funds. They don't tweet, they don't day trade, they don't move very quick either. But they move trillions of dollars. They are slow, they're steady, they are predictable, and they quietly influence interest rates, liquidity, valuations, really all over the world. So let's get into it. So what exactly is a pension fund? A pension fund is a long-term savings vehicle. It exists to meet a future promise. For example, we will make payments to retirees 20, 10, 40 years from now. So, but to meet those promises, pension funds invest today, manage risk over decades, target specific return profiles, adjust portfolios slowly, and rely on predictable cash flows. So there's two key types. There is defined benefit and defined contribution. The defined benefit, this is where the fund promises a fixed benefit amount. The investment risk sits on the fund, basically. In a defined contribution, the contribution is fixed, not the payout. Investors choose allocations, and the investment risk sits on the individual. Okay, so the risk is passing through to the individual, to the holder. So, and we'll call defined benefit DB and defined contribution DC. So DB plans are the giants of global financial markets. Call it the deep whales of capital. And why do pension funds matter? Pension funds are at the very top of the investment horizon spectrum. They don't think in terms of next quarter, next year, or even the next 5 years. They really think in decades. And because of this time frame, they absorb long duration assets, supply stable funding to markets, act as anchors to valuations, and provide predictable flows that shape the yield curves. So pension funds are volatility absorbers. They dampen shocks by buying when others sell. They are not dealers. They are not liquidity providers in real time, but they stabilize liquidity over long cycles. Why do pension funds move slowly but powerfully? So pension funds have predictable contributions, predictable outflows, predictable long actuarial models, and strict mandates. This means they rarely panic, they rarely dump assets, they rarely chase momentum, and they don't care about short-term noise. But when they do move, they move in massive size. So examples, annual rebalancing, shifting equity to bonds, adjusting duration, hedging liabilities, managing funded status gaps. These large scheduled adjustments can move treasury yields, equity valuations, funding markets, and long duration bond prices. Let's talk about something really interesting with pension funds, and that is liability-driven investing, LDI for short. So many pension funds, especially in the UK and Europe, use something called liability-driven investing, and we'll call it LDI for short. Some LDI strategies use long-duration bonds, swaps, derivatives, leverage to match the duration of their future liabilities. This means when long-term yields fall, liabilities get larger. Funds buy long-term bonds. So when long-term yields rise, liabilities shrink. Funds sell long-term bonds or hedge differently. So this relationship can create feedback loops. We saw this dramatically in the 2022 UK crisis, where rising yields, triggered margin calls, forced pension funds to dump long duration assets, causing yields to spike even more and requiring the Bank of England even so much to intervene. So a lot in action here when we talk about pension funds. How do pension funds create flows that move markets? And I'll lay out a few, maybe five. So here are the major ways pension funds influence global asset prices. Number one, rebalancing flows. So every quarter or year, they rebalance back to target allocations. So if stocks rise too much, they sell equities and buy bonds. If stocks fall, they buy equities and sell bonds. This stabilizes markets. Okay, so that's number one. Number two, duration demand. Pension funds love long-term bonds. Their demand shapes yield curves, swap spreads, treasury supply-demand balance. Okay, so that's an important one, duration demand. Number three, private market allocations. They are the backbone investors in private equity, real estate, infrastructure, private credit. This slows liquidity cycles and adds persistence. Okay, so private market allocations, huge. Number four, I would say hedging and derivatives. They use swaps to hedge liabilities, which impacts swap markets, long-term funding costs, discount rates, and corporate borrowing costs. Okay, so number four, hedging and derivatives, huge numbers. Number five, liquidity constraints. They are slow, but when forced, as in 2022 in the UK, they can cause enormous market swings. So those would be the five reasons how they create flows that move markets in large quantities. So let's talk about pension funds and the discount rate. This is tying everything back into valuation, and we talked about discount rates in episode 10. Pension funds are a major force in determining the level of discount rates. Why is this? Because they absorb duration. They influence yields. They buy during risk-off periods. They sell in risk-on periods. They hedge via derivatives. And they hold assets for decades. So more demand for long-term assets, lower discount rates. Less demand, higher discount rates. So when pension funds shift even slightly, global valuations move. So why does this matter for us? So pension funds influence the yields on treasuries, corporate borrowing costs, mortgage rates, equity valuations, private equity returns, real estate cap rates, funding markets, swap curves, the global discount rate. Even if you don't invest in a pension fund, you are living inside the system shaped by them. So understanding their behavior helps you understand market cycles, interest rate movements, maybe valuation waves, long-term pricing of assets, and liquidity conditions. So they are slow giants, but when they shift, really the entire earth tilts. So thank you for listening to episode 24 of The Global Ledger. Today we explored the pension fund ecosystem, the slow-moving giants that quietly support the global financial system, shape liquidity cycles, and really influence valuations in a way few people ever see. In the next episode, episode 25, we're heading into the world of strategy. We're going to talk about hedge funds. We call them liquidity predators or market stabilizers. Once again, I'm Justin, and thanks for being here.